So for those of you who have been around and been a part of this channel for a while now, you know that we did a deep dive on context logic, or Wish. That was about 3 to 6 months ago when the stock was actually trading up around $7. And since then, this thing has fallen. I mean, really fallen off of a cliff, going from $6.37, dropping all the way down to lows this morning of $3.56. This stock has been cut in half once again. And if you look at where it was trading just a couple of weeks after IPO back in January of 2021, this thing is down nearly 90%. And now there are a lot of times where a stock is down significantly, like a Smile Direct Club, where it warrants reason, a ton of reason. We went over this for Smile Direct Club a couple of days ago, saying how I really wouldn't touch it. I do have a small position, but I really wouldn't be looking to touch it because of the amount of debt that this company has under them. But this morning, when I was live streaming with my private mentorship group, the link is down below, I was talking with them and we went over Wish. And I said, you know what, let's just take a look right now at how this thing looks from a fundamental standpoint and if I would be investing in it. So this video is not really going to be a deep dive on how the company makes money. We've already done that before, but it's going to be more of an update as to the financials, how things are looking right now, and ultimately if I think that this is a good buy. So hit the like button, subscribe to this channel, guys. Go ahead and check out our Discord. It is completely free. The link is in the description. You guys get access to all of my courses that are completely free. I have 3 courses out right now that are free. You also get access to our live stream. So I live stream over there every single Sunday with them, completely for free, and you get access to one of the best unusual options technical analysis bots in the game, which nobody gives out for free, but we are giving it out for free on our Discord because fuck the other guys, right? I'm just joking, but not really. But looking at context logic, if we look at some of the main risk factors as of right now, there's a couple of problematic things. So the very first thing is that they are not forecasted to achieve profitability within the next 3 years. So things can change, obviously, but as of right now, if you're somebody who is trying to invest in them for the next 3 to 5 years, they are not going to be profitable. It doesn't mean that the stock price can't go up. It just means that the company will not be profitable. However, this isn't always a bad thing. Up until about 5-6 years ago, Amazon wasn't profitable. Tesla wasn't profitable. Some of the biggest companies in the world are not profitable. Now, as far as context logic is considered, just because a company's not profitable doesn't mean anything. What means and what matters is how much money they are burning through each and every single year, and if the amount that they're burning through is getting worse and worse every single year, or if it's getting better and better every single year. So we're going to talk about that in a little bit. Now, the next thing, is their share price liquid and stable? No, it is not. Their share price is not liquid. I mean, it is liquid, I should say, but it's not stable. Obviously, the stock IPO'd back at $19.84, nearly doubled at $33, and then has dropped down to $3.85. So definitely a ton of volatility. And has there been a substantial amount of insider selling within the past 3 months? Yes, there has, and we're going to go over that as we get into the insider selling, section that they basically have here. Now, what are some of the good things? Number one, revenue is forecasted to grow at an average of 25.8% per year for the next 3 years, which is massive. That's like a 75% growth rate within the next 3 years, which is a very good sign. Are they in a good financial position? Now, this is where I kind of talked about this when we went over the Smile Direct Club, where like to them, what is a good financial position versus what to me is a good financial position. To them, they have at least 1 year of operations in cash. So to them, that's good. They don't have a dividend, obviously. They do have sufficient data for their financials, which is good. Are they concerning any recent events? No, they're not, blah, blah, blah. So what are some rewards for them? It is trading at 90% below their fair value. So this means that they have a fair value of $36 on context logic. And I will be straight up honest, that is not accurate in my opinion. One thing you have to look at when you're looking at fair value is to understand how these companies end up getting their fair value numbers, because this is ridiculous. In my opinion right now, fair value for Wish is probably right around $4.60 to $4.70. If you guys ever want me to do a video on how I find book value or fair value or basically underlying value, please let me know. That I will do a video on that in the future. Now, I don't think it's below their fair value, obviously. If you guys don't know what the company does, by the way, too, they operate as a mobile e-commerce company in basically most of the world. The company operates on the Wish platform that connects users to merchants and also provides marketplace and logistics service to merchants. Basically, it's like the dollar store for the internet. We've talked about that before. We have seen other companies do pretty well, like Alibaba, using AliExpress. Basically like that, like knockoff cheaper versions of things that, if you don't want to spend a ton of money on, you can get the Wish version of it, which there's also pretty, bad, basic sentiment that comes with that, like the quote Wish version of something, because it usually means it's crappy and cheap. So not the best, as far as like their brand and whatnot, the brand name and stuff, but still it has its place in the market, especially when we look worldwide, not just the United States, but worldwide. It definitely has its place in the market. Now, future growth, and this is why you would normally purchase a company who is burning money that's getting the crap beat out of it, is because the future growth should be insane. They're projected right now at a 25.8% forecasted annual earnings growth, which is good. It's nothing nuts, right? For the amount of risk that you're bringing on, it's nothing crazy, but it is still very good. 25% growth year over year. Company is growing. That's very good. The industry is looking to grow at 31.9%. They're only looking to grow at 25%, which is better than the market, but the industry still overall is beating them, which is not the best. Future return on equity is a minus 23.7%, not the best. Past performance, negative 38%. Past earnings growth, minus 38.3%. The industry was like plus 30%. So definitely lagging behind overall. And financial health, which this is very, very important here. So looking at financial health, this is actually one of the best parts about this company, which is pretty funny, is that even though the company is burning through revenue and burning through money, not revenue, I should say, but burning through money, financially, it's not that unhealthy. So really the growth, I wish there was more growth at this company, which is one of my gripes. And while they are losing money, it's actually not looking too bad short and long term. So as of right now, their short-term assets is 1.3 billion. Their short-term liabilities is 518 million. So 2-to-1 short-term, which is very good. We see double the amount of assets to the amount of liabilities, which we see here. Now for long-term liabilities, which is anything owed 12 months or further, we can see their long-term assets are 50 million and their long-term liabilities is 18 million, which is a very, very good sign as well, nearly double there. So while we are seeing a company that is not making money at this current point in time, we are actually seeing a company that knows how to knows how to not bring a ton of debt into the company. And their balance sheet actually does look pretty good for a company that's losing cash. And so you can see right here, they do have a stable cash runway. They do have sufficient cash for more than a year based on its current valuation and its current liabilities. You can see here, cash and short-term investments is 1.2 billion. Equity is 829 million. Other liabilities is 466 million. So very, very good. Double equity versus liabilities, which is a very good sign. Obviously, the stock does not have a dividend at this point. They don't have anything as far as that's considered. As far as and this is nuts here. I just want you guys ever want to have fun, right? If you guys ever want to have fun, I highly recommend you go and see how much money these CEOs get paid. It's freaking nuts. We looked at Smile Direct Club. Their CEO gets paid like $2 million a year. Peter Schweizenack, Schwaltzky, I don't know. But yeah, he's been there for 2 years. He's getting paid $78 million. $78 million per year. What am I doing making YouTube videos when I could just go be the CEO of Context Logic? Now, but honestly, absolutely crazy. Good for that guy, but they are paying him a ton of money. If we look at the leadership team, to be honest, because I'm not invested in this company, I don't know any of these people, but whenever I do actually invest in a company, I will look into the leadership team and I will actually view their profile. There is actually a way that you can look them up on LinkedIn, see what they've done before. Like, I would actually look into that if I was actually going to be investing in this company, but basically short story, I'm not. I might actually throw some money in, but we'll talk about that in the middle. Wish's management team is not considered experienced with only 1.9 years in their tenure. And then insider trading volume. So this is very, very important here. One thing Simply Wall Street does really well, even though we have no affiliation with them, is they actually have a very good insider trading volume section. And we actually have an insider trading volume section within our AI bot over here in the Discord. But you can see here recently, within the past 3 months, there has been $8.1 million worth of shares that have been dropped from the insiders. So this will actually show you the who sold these shares, how many shares they were, and it's never a good sign. It's never a good sign to see insider selling as a stock is dropping. If the people who basically run the company and believe in the company the most are selling, it's never a good sign. Now, for instance, with something like Tesla, where we have seen Tesla, Elon Musk selling shares of Tesla, he's selling such a minuscule amount of shares for Tesla that it doesn't even matter. So that's not even that big of a deal. Like, for instance, here, shareholders, he still owns $187 billion worth of stock. So for Elon to sell 2 million or 2 billion or something like that and 3.6 billion, it's really not that big of a deal. So guys, overall, I hope that this video helped. To be quite honest, I don't really like Wish. I feel like financially they're not in as bad situation as most people would think. However, from a growth standpoint and where I see this company within the next 5 to 10 years, it's very tough because, like I said, there is a negative stigma around Wish, and I don't know if they're going to be able to overcome that. It's really going to be up to the rest of the world, not just the United States, to help push this company up, which they're doing it now. But for me, like, I'm just not a user of their product. I just think that everything they make is cheap and crappy. And if this thing does get driven down to like $3, I might throw a couple $1,000s in just as a YOLO in hopes that they can turn things around. So guys, thanks for all the support. Hit the like button, subscribe. Also, have a great Thanksgiving. I'll see you guys on Friday. Peace.